Good morning, traders. Today we are looking at WTI, and the key point is very simple. Oil has stayed really capped below the 100 handle, even during this bounce that we did actually point out in our weekly analysis. That tells you that the market is still hesitant, even with the geopolitical risk premium not fully gone. The fundamental backdrop has softened a bit into the weekend. Trump says the Iran war should end soon. There may be talks over the weekend. And we also had a 10-day ceasefire deal between Lebanon and Israel that kicked off actually last night. That has helped keep both Brent and WTI below the 100 mark, and with traders, of course, dialing back some risk premium for now. At the same time, the broader supply story is still not entirely bearish for oil, for WTI at least. The IEA says that lost Middle East output could take around 2 years to recover. So structurally, there is still an argument that crude should remain supported. Right now, price action is telling us the market cares more about near-term de-escalation than longer-term tightness. So on our weekly analysis, we already looked at this potential dead cat bounce, and that is exactly what happened. Price bounced, but the move stalled at around the 98 level. The sellers stepped back in, and more importantly, that bounce failed to reclaim, of course, the 100, stopping between the 50 and 61.8. It's still a bit of a deep retracement for a dead cat bounce, but it is within the limits, which reinforces the idea that this was corrective, not the start of a fresh impulsive rally, right? And then off we go. We went down and we did a new low, which on the one hand does tell us that that cat bounce might be done, but on the other hand, if we look at it from a historical perspective, we're not typically doing just the 61.8 Fibonacci extension of the first leg when we're looking at dead cat bounces. We're looking at further moves into deeper territories, which brings us currently to around 77.50. Okay, we will get back to that. But for now, what is important to mention is that we had an RSI divergence over here with this spike to the downside. If you consider a spike, it's a reverse spike. So currently, the current actual move to the upside might just be simply corrective as well, which would suggest if we do break out below 89, that we could see the door to the downside opening once again. So yes, in the very short term, we can still see a recovery to the upside. But if we do maintain, let's just pull out a new Fibonacci, the 50 Fibonacci here at 9160, even let's say 9320, then the bigger question is, whether we can really see another move lower or not. So it really depends on whether this swing high actually holds. This is where the pattern matters as well. So if the bounce continues, which so far looks corrective, to be honest, this structure to the upside, we could see further upside. Are we going to retest the 100? We could retest the 100, but if we retest the 100, the dead cat bounce is invalid. If we do retest the 100, it would probably mean that we are looking at a potential triangle or pennant pattern, okay? And that would again bring prices up near the 100 and the top trend line, which would again suggest a further decline. So we either do a pullback and move up, or a pullback, stop here and continue higher in a triangle, or a further continuation to the downside, which would initially be 77.56, then 75.70. So as long as price for now remains above that low, we could still see a triangle, even if this is a dead cat bounce. Okay, and that is important. That would be a dead cat bounce in one of the legs of a potential triangle pattern. So there are really two scenarios, right? One is a short-term bounce, and we get the triangle formation or pennant. and WTI would retest the upper trend line here, maybe not even revisit the 100, because you can never know how slopey the trend line is going to be. In theory, and the 61.8 is what it's the not the limit, the entry point to a triangle. Okay, so the 61.8. So in theory, we could stop at 97, 98.74. But unless the upper trend line is broken decisively, I would still treat that as corrective. And the second scenario, the bearish continuation. If price fails around these near-term ceiling and rolls over, even the current short-term selling over here, right, then the dead part gap bounce is likely, um, you know, going to roll over to the next downside target, which is at 77.50. That would feed a breakdown of the lower trend line, a breakout over here, yeah, and continuation of the broader bearish structure. So in terms of setup, the cleaner trade for me currently is still on the short side, because this is also corrective. Okay, so conservative traders can wait for a break of the lower trend line, let's say here, which is a few dollars lower, and down to 77.50, and done. And of course, the stop would have to be here. So you've got 1.3 risk reward ratio. And more aggressive traders could start looking for shorts already, um, if prices exit the bearish the channel over here. So this gives much better risk reward ratio. Also gives a little more room to pull the stop loss a bit higher. And we're looking for a much better trade. In either case, the logic is the same. Rallies are still suspect unless WTI can break structure to the upside. So watch the short-term sellings very closely. If they hold, WTI could extend lower towards 77.50. If they break, then we may be looking at a triangle first and a delayed move. Trade safe, manage your risk, and I'll see you in the next update.